Hi guys, Joshua Tharby here, live at 7 o'clock, well a couple of minutes past. So today, what are we talking about? Well, today's live is inspired by a question I saw earlier on in the group, and it's basically about what's the difference when it comes to tax between doing a flip in your own name and a limited company. So this is a hugely popular topic that we get asked quite a lot, and a lot of people don't quite understand the misconceptions around it, because there's a lot of different ways to approach it. So with a flip, if you do it in your own name, there's two things to start thinking about: is whether it's a capital gain or whether it's going to be taxed under the income tax rules. So if you were to do a flip, basically, in some cases, it can fall under the capital rules. Basically, if you live in the property, do it up, add loads of value to it, but then you sell it on, as long as it's your main residence and you intended to live in it and basically make it your home permanently, at the time you moved into it, although you did an extension or whatever it might be, you replaced it all, you ripped it all out, and you added a lot of value to the property, because at the time you moved in, your intention was to make it your home, that full gain, whether it's £10 or £100,000, £250,000, will be tax-free because it's your primary residence. You're entitled to your primary residence relief. So that's the first thing to mention, is whether it's a capital or basically trading and tax under the income tax rules. The main thing there is your intention. So you have to live in it, you have to cook in it, you have to clean in it, you have to crap in it. That's the test that HMRC put on this one. And if you don't, then they are looking at these. So if you put one through, you might get away with it. You put second, third and fourth, they're going to think, hang on a minute, this guy's doing this for a living, and they will look into your returns. And as a result, they'll look at it and say, hang on a minute, you're clearly not living in there, or you're basically doing this every couple of months. Your intention can't be to live in these properties, and they'll challenge them. And in which case, it'll be taxed as trading income. So basically, just as a normal trade, you'll pay income tax on it at your marginal rate. So 20% if it falls into your basic rate band, 40%, and then 45% as well. So the thing with flips, which usually makes them better in a limited company, is the amounts are so big. A lot of people doing a flip, you've probably got other income as well, and a flip can easily be 50, 60, 70,000 pound profit in most cases, which you add this onto 50,000 pounds worth of other income, takes you over £100,000 of earnings. So you're going to lose your personal allowance, you're going to pay tax at 40% on most of it, plus national insurance as well, as basically a self-employed individual. So you've got all of those taxes to figure out. This is where you compare it to a limited company, and you pay tax at currently just 19%. So you've got basically a lot more money left in the company. But if you are using the money to live off, you've then got to pull it out of your limited company. So you've got the double taxation side of it. That's what you've got to remember. So with the properties, well, with the funds from the property, do you want to reinvest them, get them working? Most property investors do. So that's why a limited company is the best way. But if you've got no other income, okay, so if you've got no other income at all, you're just doing a flip, you're going to make about £50,000, £60,000, and you want that money to live off and enjoy and spend, then in that case, you're probably going to be better off. You're going to be better off basically doing it in your own name, because in that case, you're not going to pay any more taxes. You're going to pay your income tax on your profits of the development, and then it's yours to enjoy and spend. But compare that from another perspective to a limited company, where if you were to basically have that £50,000, you'll pay corporation tax on the gain, then you'll pay more tax to pull it out as well, plus accountancy fees, all of that kind of stuff. The chances are you will be a little bit worse off. So that's what you've got to compare. And especially this is even more true when you factor in that from next year, April 2023, corporation tax rates going up to 25% for most companies. Basically, you also have a small profits threshold where they're taxed at 19%, but this is split across a number of companies you've got. So if you've got 5 companies, you're actually only getting your first £10,000 worth of profits taxed at 19%. Then everything over and above that is effectively at 26.5%, but we'll keep it simple and say 25%. Okay, so that's what you want to be thinking of. If you are looking to use the money to live off, you've not got any income, probably do it in your own name. But if you do want to use the money to reinvest, you want to suffer the least amount of taxes, you've got other income, look at a limited company, because you're going to pay the least amount of tax, you've got more there to reinvest and to build up that pot, because that's why most people do flips in properties, for a bit of income to basically give a lump sum to put into more properties. So either of those two would be the best. Of course, these numbers change massively if you're doing it with somebody else. You've got a joint venture. In that case, you might be saying, look at a partnership or an LLP or a limited company. So as always, it is best to get professional advice, but I thought I'd hop on and give some fantastic pointers. If you found this video useful, please do make sure you are giving it a big thumbs up, guys, pressing that like button. Otherwise, thank you very much for watching, and I'll see you all tomorrow.